Hello everybody, welcome to the channel where we bring you information and education. Now in today's video, I'm going to show you how you can use life insurance to build generational wealth. Just life insurance. Now I want you to stay locked in because what I'm going to share with you today is going to absolutely blow your mind. I remember the first time I realized that I could do this, I was absolutely blown away. So I want you to stay locked in and watch. So if you've been watching the channel, you will know that the Index Universal Life is one of my favorite vehicles to use as a permanent policy, right? Because it has upside. I like the tremendous upside that it has. You can use a regular whole life as well, but I like the Index Universal Life. So this example I'm going to show you using an IUL, Index Universal Life. So let's take a 30-year-old businesswoman for this example, all right? So she's 30 years old. She's 30 years old and she wants to fund her policy with $1 million, okay? She wants to fund her Index Universal Life with $1 million. She can afford to put, based on her business revenue and all that, she can put $100,000 per year in that policy. So she wants to fund it with $1 million and she's going to put $100K per year. So it's going to take her 10 years to fund this policy. And after 10 years, she's done funding. She don't have to put any more money into this policy. So 10 years, and she's got her $1 million. Okay, great. So in this example, let's say she's gaining 8% on her money. Okay, these type of policies typically average anywhere from 8 to 10%. So let's use 8% on the lower end, right? So 8% she's getting. And if you know the rule of 72, you would understand that you divide the interest rate into 72 and it will tell you how long it takes for your money to double. So in this example, 8 into 72 equals 9 years. 9. So every 9 years her money will double. Okay, so 9 years the money will double. Okay? So how does this look? So at 30 years old, she wants to put $1 million. So at 40, 30 is where she starts, okay? And at 40 years old, she now has her policy funded with the $1 million, okay? So she's done funding now. So that $1 million is going to double. She was gaining like minor interest on the way, but not significant while during the funding time. So let's just use $1 million. $1 million is what she has, right? So at age 49 years old, it's going to double to $2 million. Okay, she put in $1 million, and this is going to double to $2 million. Okay? And what's 9 years after that? 58, right? At 58 years old, she now has $4 million. Because her money is compounding. So each time it's doubling, right? So now she has $4 million. $2 million double is $4 million. So now she has $4 million at age 58. She started at 30 years. So she had $58. At age 58, she has $4 million. So 9 years added to that is what? 67 years old, correct? Yep, 67 years old. She's going to have $8 million. So she only funded that policy with $1 million, but she grew that policy to $8 million. She put it, that's 8 times what she put in. And she funded that. And that money will keep growing as long as she wants it to from what she put in, right? So $8 million. Now let's say in retirement years, she wants to pull out money from that. She's going to pull out this money tax-free for retirement income. And I'll explain to you how that works in a second. But one side note I want you to know is that during that time here, when she had her money in the policy, she was able to borrow against her policy, right? So let's say at the $1 million, she wanted to borrow $500,000, $500,000, right? She could borrow against this policy and take 500,000, the insurance company will actually give her that money. She doesn't have to pre-qualify to do that. She doesn't have to have a particular credit score. She doesn't have to fill out an application. She does none of that. This is her money, and the insurance company is willing and able, would always say yes. All she has to do is fill out a one-page form, say I want to borrow against my policy. She gets that $500,000 and she goes and invests into real estate or whatever business or whatever for working capital for her business. She goes and make money on top of that. She keeps the profit, pays back the policy. Now all this time while she borrowed against a policy, because her $1 million is still there. She's not taking from her policy. She's using her policy as collateral. So the insurance company is lending her that money. She borrows that money at 5%. At 5% she borrows that money. 5%. Okay? But she's earning 8%. So she makes a 3% spread. She earns 8% and she makes a 3% spread. So she's borrowing and still gaining even though she's borrowing. Right? Absolutely powerful. She's still gaining money even though she's borrowing against her policy. And she pays that back, keep her profits, and she can do that over and over and over and over and over again. So she has a personal banking system. This is what it means to have a personal banking system. She can go and use that money as leverage. And she can borrow, and the insurance company will always give her money. And her money is still gaining interest uninterrupted. All right, so she's doing that. Now at age 67, she's in retirement years, and now she wants to pull from her policy, okay? She wants to borrow against policy. She's going to borrow this. And this money is going to be tax-free because loans are not taxable. IRS code, right? Loans are not taxable, so she's going to get this money that she's going to use as retirement income, but she's taking it out at the form as the form of a loan. So it's not taxable, no tax. All right, so she's going to say, let's say she want to take the 8% out. She's got 8 million, right? She's got 8 million in the policy. She wants to take 8% out per year. So she's going to live on 800,000. Who can live on 800,000 a year? Okay. I'm sure everybody could do that, right? She's going to live on that 800,000 per year, and her money is still gaining 8%, so it's going to be a wash. She doesn't have to pay that back. Remember, she's taken out as a loan, but she's not paying it back. She's using it as retirement income. So she's going to take that out, and she's going to pay it back when she dies. The company will take it from the death benefit. So all that interest that the policy was earning, that's what's going to pay for the loan that she was actually pulling out. So the interest will pay back the loan. So when she dies, 8 million is going to go to her heirs. Because remember, the interest washed out the loan money, right? So 8 million is going to go to her heirs. Okay? So what they're going to do is follow the same strategy. They're going to do exactly what she did. They're going to take that 8 million and they're going to go put it in an index universal life policy. Do the same thing. All right? So they're going to do it over again. They've got 8 million in a policy now. And their policy now is going to double every what, 9 years, right? Every 9 years, just like, so this is going to turn into 16 million at some point. So they're going to do the same thing. So they're going to continue on what she did, and they're going to be able to do the same thing she was able to do. They're going to borrow against their 8 million. Let's say they want to borrow $1 million, go do what they need to do, invest in their business, make profits, pay it back just like she did, and grow, let it grow. And they're going to do the same thing in retirement. They're going to live off the interest. They're going to be able to even pull out more money out of retirement, because at that point when they retire, the policy is going to grow even more, right? And they'll do the same thing with their heirs. When they die, they pass it on to their heirs, and their heirs will go open another policy like this, and they continue. This is how you create a legacy bank. This is money that lasts, that doesn't die. It's going to continue to grow. It's not about, dying and giving your heirs money so they can go spend it. It's a system that's set up where they're going to now do the same thing, and they can have access to it for capital for their business and have their business produce money for them to keep. Meanwhile, this is still growing and the money doesn't die. It lasts. This is what generational wealth is about. The reason why we don't have generational wealth, or why we're lacking, is because we don't understand these type of strategies that could keep the money growing and having a system set up that it's going to last forever and keep growing. And the next generation is actually building on top of what you've created instead of spending the money. I hope that makes sense, right? Now, I want you to understand that some of your favorite companies use this type of strategy to run their business for working capital. The Coca-Colas, Walt Disney, JCPenney, McDonald's, all these companies has a banking system through their insurance that they pull money from to run their business. And that money keeps growing because they're not actually taking out of their policy. They're using their policy as leverage, as collateral to borrow from the insurance company and making more than the interest that they're paying back. I hope this information was very valuable to you guys. Like I said, when I found this out, I was absolutely blown away. You can use just this strategy to actually build generation wealth and have the money continue to grow generations after generations after generations. So if this information was valuable to you, I want you to do a few things for me. I want you to like the video. I want you to place a comment or ask a question if you have a question. Then I want you to share it with someone that you think could benefit from this information. And as always, if you haven't subscribed to the channel, make sure you go ahead and subscribe now. All right? And hit the notification bell so you're actually notified every time I drop a video so you don't miss any information. All right? So until next time, see you soon.